So, Fraser, today I just really wanted to talk a little bit about reverse mortgages and how it is no longer the loan of last resort for our senior community. It can certainly help in financial planning. It could certainly help in those seniors that worry that they are going to outlive their retirement savings and can have some understanding of how a reverse mortgage can help mitigate maybe rising health costs. Maybe they need assisted living. They want to remain in their home. It's a family affair. It always is. But there's a lot of misconceptions about reverse mortgages. And today I just kind of wanted to talk about the 10 myths and how we're going to bust those myths. Each of these needs a little bit more explanation than what I'm going to go through, but I wanted just to kind of bring this up to dispel any misunderstanding about reverse mortgages in general. So number one is the home reverts to the lender upon vacating the home. That is completely false. The owners of the home remain in title on the home. They are in control of what the outcome with that home ultimately will be. And if should they pass away, it would be the heirs that would be in control of the outcome of that home and what they deem to do with it after that point. The second myth is that the entire debt is due and payable within 30 days of an event that causes the reverse mortgage to come due. That's false. Typically, the servicer wants to understand what the heirs might want to do with the property. If they want to list it for sale, if they want to buy it, they might have 6 months with extensions up to a year. The borrower or the heirs are responsible for the debt? Absolutely not. These mortgages are self-sufficient. They are non-recourse loans. So that means that the heirs would not be responsible for the debt, and the house as collateral is always sufficient to cover whatever is owed on the property.
So Kelly, can I ask a question about that? So you're saying that there is no circumstances, because I think that is something, like you said, it's a myth where the concept is that somehow you get underwater, right? Like the loan, the interest, maybe the person's living for a long time and the interest grows. And so now when the person dies or moves out, they're going to have to pay something. So you're saying that the home, the equity, whatever, is always sufficient for the loan.
Correct. So in an example, the property is worth $500 and the loan amount is $550. Okay. And the owner passes away or vacates the property entirely. So now you would say that house is underwater by $50,000. Well, there's insurance in place on this mortgage program that covers that gap. So the heirs can let the property revert back to the lender and would not be responsible for any gap in what is owed on the property. That is a feature of this loan. Gotcha. So it would never pass to the heir. Now, in the same scenario, if the heir wants to purchase that property's worth $500, the loan amount is $550. This program provides for the heir to purchase the property at 95% of whatever the current value is. So even though $550 is owed, the current heir could purchase it at 95% of the appraised value, or $500,000. And that property could remain in the family if they desire to do it that way. So gotcha. The heirs are never responsible for the gap. And there is a mechanism by which the heir can purchase the property if they want to retain it. Gotcha. The title to the home is in the lender's name. That's completely false. Title is always in the owner's name. The loan can be called for any reason, meaning the lender can call in due and payable clause for any reason. That is also false. Certain things that would call a loan into foreclosure or Due and payable would be if the owner stopped paying its property taxes and insurance, which are required on every loan, whether it is a reverse loan or a forward loan. If you stopped paying your property taxes or homeowner's insurance and the property went into default, any lender could call that loan regardless of the type of mortgage that's on it. The borrower can have the note called because of age. That also is incorrect. You're not going to age out of this program. Once it's set up, period. I think the age that they put in the mortgage instrument is 150 years old.
Very realistic. Very realistic.
Yeah. If payments are made, they are not tax deductible. That's false. So some people want to make mortgage payments on their reverse mortgage. They decide to use their retirement assets and keep them invested with their financial planner, make some gains on them, and maybe at the end of the year, they want to make a principal payment against the reverse mortgage to bring the balance down. That's treated, if it's mortgage interest that's paid, it does qualify into whatever the IRS might consider your deductions would be for mortgage insurance, just like any other mortgage payment. If you're making a mortgage interest payment, you would get the same tax documentation to show the interest you had paid on that loan.
Now, Kelly, you just said principal though, but it would only be mortgage interest.
Mortgage interest, right?
Yeah.
If you're making a principal payment, like a payment that includes a reduction to principal as well as interest,
right.
The interest portion would be issued that tax document at the end of the year. I would just encourage you to do it before December 31st of the year, so you have it for your tax prep the following year. There's no monthly payment. False. That's too broad because there are taxes and insurance payments that you must make on your property. You do not have to make principal and interest payments on a reverse mortgage, but you must maintain your real estate property taxes and keep that current, as well as your homeowner's insurance and keep that current.
And Kelly, would you say that the primary, benefit of the reverse mortgage is that you don't have to pay, you get to stay in your house and you don't have to make a mortgage payment. You still have to make a taxes and insurance payment, but you don't have to make a mortgage payment. And then in theory, you can also write isn't there also a world where, let's say you own the house free and clear? You can also pull money out of the house.
Correct.
When you do a reverse mortgage. So not only can you pull money out of the house, stay in the house, but you also don't have to take a mortgage payment, or I'm sorry, you don't have to make a mortgage payment.
Correct.
That is why a reverse mortgage is cool and interesting.
Sure. There's a lot of, and this provides you far more opportunities to use your home equity as a material asset. Okay. You might have a situation where you need, in addition to your pension you receive each month, you want some cash for various reasons. You might set this up as a stipend, as a monthly draw, so that you have additional tax-free cash that you can work with each month to improve your quality of life. You might set it up as an equity line of credit and only draw against it for those vacations you want to take each year, right? And still not have a required monthly payment on whatever you take. So there's many, many ways to use a reverse mortgage to enhance not just your retirement savings and guard against rising costs as you age, but also concerns about the costs of assisted living in your home, bringing in in-home care, your health needs, the health needs of your spouse. There's just so many different ways that turning 62 and having some equity in your property that you can now access without having to make monthly payments can benefit your life. Okay. There's several ways that you can receive the loan funds. As I just discussed, many people thought there was only one way you could take it, as in a lump sum, and that's incorrect. And the funds are taxable by the IRS. That is false. This is not income. This is money you are taking out of your home, just like a home equity line of credit that you might have on your home right now, but you are required to make monthly payments on. This works the same way, only you don't have to make monthly payments on it. And those are the 10 myths about reverse loans.